All right. Good morning. Good morning, all you magnificent melon heads of the world. Happy Monday, everybody. Today's May 19th, 2025. The new week is upon us, and we are off to one heck of a start. Actually, this week started at the end of last week. We had our Friday afternoon news dump, courtesy of ratings agency Moody's, who downgraded the United States sovereign credit rating from AAA to AA1. They are now the third of the big three ratings agencies to cut the U.S. credit rating. I'm kind of surprised it took them as long as they did, but there it is. They finally cut it. Now, look, they follow Fitch and S&P, who cut a year or two ago. I'm not sure exactly when that cut happened, but it happened a while ago. Citing large fiscal deficits. Stop me if you've heard this one. Soaring interest rate costs. Okay, yeah. And a lack of faith that the current administration or Congress will take any steps to address the fiscal irresponsibility, recklessness in Congress. I'm having a hard time finding anything to argue with here because, well, Moody's is right about everything. I mean, look, we had that whole, let's just say it, ridiculous exercise in spending cuts for the first 3 months of the new administration, DOGE, and they found all these grotesque, idiotic examples of the things we waste money on. Right? Transgender comic book strips in freaking Bolivia. Oh, yeah, that's, really good investment in future productivity of the American workforce there. All the stupid things we spend money on, and we tried to cut spending on them, and some judge at the 11th Circuit of who cares said, oh, no, you can't do that. So it's basically impossible to cut spending. This behemoth, this giant leviathan, the bloated red tape, all right? El Diablo Cinta Rojo, the devil of red tape, cannot be vanquished. It's basically illegal. The judges said you can't cut spending. And now they're talking about more tax cuts in Congress, and they're like, oh, don't worry, we're going to have some congressional budget office or whatever is going to sharpen their pencil, manufacture spending cuts out of thin air that aren't actually going to happen, and then we're going to increase the deficit even more. And, oh, by the way, the debt ceiling is coming up. You guys remember what happened the last time they raised the debt ceiling? About June 3rd of 2023 was the last time they raised the debt ceiling. And Janet Yellen started the most grotesque issuance bender the U.S. has ever seen as she refilled the Treasury General account in order to, fill up Uncle Sam's checking account. And, well, interest rates skyrocketed almost like 140, 150 basis points through the second half of 2023. Until about October, November timeframe of that year, interest rates surged. So look, we've got sharply higher interest rates on the horizon because of way more government bond issuance as soon as the debt ceiling gets raised. We have a government that physically cannot possibly cut spending ever. So yeah, we got our credit rating downgraded. And now we're hearing things once again like sell America, like bond vigilantes. All those phrases are coming back today. Interest rates are sharply higher, especially on the long end of the yield curve this morning. That's going to hurt the mortgage market, auto finance, the asset-backed security market, all of which have their own ample problems. By the way, I have Melody Wright and Lox Ganapathy coming on the channel this afternoon to talk about some of those things that are happening in those markets. Guys, things are not looking so good for the finances of the country right now. And look, nothing has really changed over the last week. It's just Moody's finally said it. That's really the only thing that changed, and everybody's freaking out. Why? Why is everybody freaking out? This has been here all along. The doomers have been saying this the whole freaking time. Oh, but now Moody said it, so I guess it matters now. That's apparently all what it means. Also, Secretary Scott Bessent is out in the press today. He's saying that those April 2nd Liberation Day tariffs, they're coming back. Letters are coming out. We're sending a strongly worded letter. You made me do this, apparently. Look, we're going right back to those tariffs that Trump blinked on April 9th. Which means the bond market's probably going to end up throwing a fit again at some point. We have a very interesting story coming out of the European Central Bank this morning. This is interesting. I'm rather shocked by this. The European Central Bank is warning about risks to fiscal stability in the gold market. Not fiscal stability, I'm sorry, financial stability. Look, financial stability is one of those bank speak terms for like all hell breaking loose in global markets and banks blowing up and things like. When a central banker talks about financial stability, he's talking about mayhem in markets. And they're saying gold could be a cause of that. And we're not talking about Andy Schectman here doing one of his interviews. Andy's known for rhetoric of that kind. This is the European Central Bank is saying this. This just came out this morning. I think a lot of people are probably glossing over this story. Pay close attention to what they're saying. We've got the UK and the EU are getting back into bed together. I think Keir Starmer and Ursula von der Leyen had a nice candlelight dinner, maybe put on a little Barry Manilow in the background. Things went, maybe they got a little hot and fast. I don't know what happened, but this morning, the United Kingdom and the European Union are walking back Brexit, kind of. Not kind of. I mean, they're making all kinds of deals for food inspections and fishing rights and passport agreements that looks an awful lot like the other thing, before the Brexit. Anyways, I'm not surprised that's happening because, well, Donald Trump threw a monkey wrench into the whole global order of things, and the UK is looking for new friends. And so they, go right back to the rebound thing from before. On top of that, we've got President Trump taking a page out of the Kamala Harris playbook over the weekend when he took a couple of cheap shots at Walmart over tariffs. Yeah, we're going to have a little talk about that one. 23andMe is selling their DNA data bank to pharmaceutical biotech giant Regeneron. Shocking turn of events. Turns out you were the product all along over at 23andMe. We all knew that. And apparently that data is going to the drug companies now. And student loan borrowers are having one heck of a time ever since student loan payments started getting reported to the credit bureaus again. We are seeing some rather rapid declines in credit scores, more than 100 points at a time. And while everybody's worried about, hey, it's going to be harder to get a loan, harder to get a mortgage, they're going to garnish my wages. What about the credit markets? What about asset-backed securities? What happens to the value of debt when the credit score of the person who owes that debt suddenly drops by 150 points? Well, that debt doesn't get more valuable, I'll tell you that. So there's a lot to keep an eye on this morning, guys. Why don't we shrink my big melon of a head and let's see what's going on in the markets today. Don't forget that like button and that subscribe button for the YouTube algorithm because we do this one every day. So come on back and have your coffee with the melon heads tomorrow. Right now, the S&P 500 is lower by about 63 points, 1% in the red this morning. We've got the Dow is off by 267 points, about 0.2% lower. The Dow was at one point this morning off more than 300 points. And the NASDAQ is leading the way lower, 308 points in the red here, 1.44% lower ahead of the opening bell. Looking over at the U.S. dollar, the Dixie is sharply lower here at 77 basis points to the downside, almost entirely driven by that downgrade by Moody's here, 100.32 for the DXY. And also worth keeping an eye on, that Japanese yen, since we're talking about a big drop in the Dixie. We have got the yen strengthening again this morning. We're looking at USD JPY here, or the number of yen it takes to make $1. When this chart moves lower, that is the yen strengthening versus the dollar, and it's higher by about 55 basis points this morning. You can see after a period of weakening in the yen that followed the backtracking on tariffs in April, we've actually seen the yen start to strengthen. We got 4 or 5 red candles in a row here. So keep an eye on that yen carry trade possibly coming back to the forefront. Now, here's where most of the movement is this morning. The bond market, especially the long end of the yield curve, is throwing a little bit of a fit here this morning. Check out that 30-year treasury above 5%, 5.028. That's higher by 13 basis points here off of this Moody's downgrade. The 20 years off by almost 13 points as well, 5.053. Meanwhile, the 10-year is also getting in on the action this morning, 4.55%. That's up by 11.5 points. And then as we get closer to the shorter term stuff, the move is not quite as pronounced. The 2-year, 4.019. That's up by about 3.5 points. And the 1 month is up only by a half at 4.303. Now, let's take a look at a couple of things on these long-term charts of interest rates here, guys. What we're looking at right now is the 10-year yield. We're looking at daily candles. All right, here is the lead up to Liberation Day and the tariffs. And then immediately after Liberation Day, the bond market said, OMG, what was that? And we had this big surge in interest rates, ultimately culminating with the April 9th backtracking. It took a day or two for the bond market to settle down. But you may notice the levels we're at right now. Here where we are, 4.552. We are just a hair below the highs that we saw on April 11th in the 10-year yield. Guys, remember the debt ceiling hasn't been raised yet. All that new issuance is going to start just as soon as they raise the debt ceiling. And if you want to know what that looks like, we got to zoom way out on this chart here. And look, here is the last time we raised the debt ceiling. Right here, I've got it circled. June 3rd, 2023 was the last time we raised the debt ceiling, and we saw about a 140-point swing up in the 10-year yield following that raising of the debt ceiling and all of Janet Yellen's new issuance that followed. And so, take a look at that move. If we were to extrapolate this and say, just pick this up and put it over here, let me see if I can get this to work. What would happen if we were to make this move now? Well, that would put us somewhere around, we're pushing 5.6, about 5.8%. A similar move would put the 10-year yield now, assuming we were to make the same move. I'm not saying that's exactly going to happen. But the point is, guys, interest rates are heading sharply higher from here. We may get a panic. We may see a freak out in the bond market, a flight to safety at some point. But with all that new issuance that's coming, new bond supply, if the demand stays the same, actually demand is falling right now, that means prices are going to fall. And with bonds, when prices fall, interest rates rise. Now, the 30-year, we're looking at the same thing here, guys. The 30-year Treasury, again, daily candles, we're actually higher right now than we were at not the all-time high, but the high that we saw back in April before the tariff panic. So the 30-year is moving even faster. And once again, if we zoom way out on this chart, you can see right here was the last time the U.S. raised the debt ceiling, and we had a move of about 140 basis points following that, which would mean we're looking at a 30-year Treasury somewhere around 6.3 if we get a move like that following this next debt ceiling. Guys, the point is interest rates are going up, and this is one of the reasons that Moody's downgraded the credit rating. Now, looking over at the commodities board this morning, we have got gold is sharply higher, $37 to the upside. That's about 1.18% higher, $3,240 for spot gold. Spot silver is also higher this morning, not quite as much, about 13 cents or 0.4% higher for spot silver at $32.40. I like the shiny. We've got copper is higher by 1%. Platinum's down about 0.1%. Palladium is up by 0.3%. And crude oil is lower by about 0.6% here, 61.59 for July WTI futures. That's off by about 36 cents. Now, I wanted to talk about this one in Bloomberg this morning. This is kind of crazy to see this. Gold markets are cited by the European Central Bank as a risk to financial stability. Again, financial stability is a very strong word. When bankers use that phrase, you pay attention, all right? They're talking about mayhem in asset markets being caused by gold. So what's going on here in gold? Gold markets could be a source of danger to the Eurozone's financial stability in the event of geopolitical stress, the European Central Bank said. Demand for physical settlement, the dominance of large-scale traders, and opaque transactions all combine to pose a wider threat if things go awry, four staff economists wrote in a note published on Monday that will feature in a big risk report scheduled for Wednesday. Should extreme events materialize, there could be adverse effects on financial stability arising from gold markets, they wrote. Vulnerabilities have arisen because commodity markets tend to be concentrated among few large firms, often involve leverage, and have a high degree of opacity deriving from the use of OTC derivatives. Now, they're talking about the big move here. Margin calls and the unwinding of leverage positions could lead to liquidity stress among market participants, potentially propagating the shock through the wider financial system, they wrote. Additionally, disruptions in the physical gold market could increase the risk of a squeeze. Guys, this is not one of these gold salesmen that's saying that. This is not a gold bug. This isn't a doomer YouTube channel. This is the European Central Bank saying there is a risk of a squeeze in gold markets. Demand for the metal in the U.S. in anticipation of Trump's tariffs already caused a logjam at the Bank of England's vaults earlier this year and prompted a surge in Switzerland's trade surplus with the U.S. because of the need for refining to recast bullion shifting from London to New York. Delivery issues could be a source of stress in the future, said the ECB economists. Market participants could be subject to significant margin calls and or have trouble sourcing and transporting appropriate physical gold for deliveries and derivatives contracts, leaving themselves exposed to potentially large losses. Look, this is what the gold bugs have been saying for years. The difference is it's not the gold bugs saying this. It's the European Central Bank saying this. And if they're citing this as a risk to financial stability, that means that whole exercise that we saw during the first quarter. Remember that guy from the London Metals Exchange talking about there was a lorry in the bullion yard. Remember that story? That means that whatever happened at the London Metals Exchange and whatever happened in those vaults was enough to spook the muckety-mucks in Europe that they're issuing this report saying it could be a risk to financial stability. There could be a risk in a squeeze of the price of gold, sending gold prices sharply higher, which would wreak havoc with the global financial system. Also going on this morning, we have got Bitcoin sharply lower this morning after Bitcoin traded sharply higher over the course of the weekend, making for a couple of interesting candles here. Again, we had a really nice price action in Bitcoin yesterday. We went as high as 107,000 this morning. It was looking like Bitcoin could be breaking out to new all-time highs and then slammed this morning, $4,000 lower, back down to $102,400 for Bitcoin. So what's going on here this morning? We did find this one. Michael Saylor Strategy acquires another roughly 7,400 Bitcoin for $765 million. But that's not the thing here. Amid new investor lawsuit. Oh, wait, what? That could potentially be a thing. Let's scroll down past them buying Bitcoin and their infinite money glitch. In today's SEC disclosure, Strategy also said that it is facing a class action lawsuit filed on May 16th in the U.S. District Court for the Eastern District of Virginia. The suit alleges that Strategy and its executives made misleading statements and failed to disclose risks related to its Bitcoin strategy and new crypto accounting rules. The firm said it would fight the lawsuit, but noted that it is unable to predict the outcome or quantify potential losses for now. So that could be what's contributing to this sell-off in Bitcoin this morning. Strategy shares are down about 2% here, $8 lower at $391. To be honest with you, considering the size of the move in Bitcoin, I'm surprised Strategy's not down more than that. But we'll keep an eye on that class action lawsuit and see what comes out of that one. Now, also going on this morning, or late Friday, this is the story that kind of set all these events in motion here. The Moody's downgrade. Moody's ratings downgrades U.S. rating to AA1 from AAA and changes the outlook to stable. Now, here's the reasoning that they're offering. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. All right, successive administrations. All right, this is several presidents in a row going back to, George Washington. They've all increased the debt. Congress, next to worthless. All right, and they're saying we have no confidence they're going to do anything. We do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. All right, so they're kind of suggesting here this tax bill that's being stalled or whatever, it's finally moving in Congress. They're saying this probably not going to help with spending cuts. It's certainly not going to help with the deficit. Over the next decade, we expect larger deficits as entitlement spending rises while government revenue remains broadly flat. In turn, persistent large fiscal deficits will drive the government's debt and interest burden higher. The U.S. fiscal performance is likely to deteriorate relative to its own past and compared to other highly rated sovereigns. Look, our fiscal house is a mess. This is not news. We've all known about this. Why Moody's is saying this now, I don't know. To be honest with you, they should have done this years ago, but they finally done it. And so now we've got bond investors detect trouble in U.S. debt stripped of its AAA rating. Secretary Bessent really wants those lower interest rates. He ain't getting them today, that's for sure. Even before talk of fresh unfunded tax cuts took center stage in the budget wrangling on Capitol Hill, U.S. bond investors were making their views loud and clear. If the government keeps spending more than it takes in, there will be consequences. Sure enough, one blow landed late Friday when Moody's ratings revealed it had run out of patience and was lowering its credit score on the world's biggest borrower below the top AAA level. It cited a years-long pattern of rising debt and budget deficits, which show no sign of abating amid deeply rooted political polarization. The bond market is skeptical that the Trump administration and Republicans will offset some of the deficit challenges, said Michael Aroney, chief investment strategist at State Street Global Advisors. What this means is that rates will remain higher and more volatile than some investors currently expect, he said. Markets have a history of being the arbiter of fiscal discipline for spendthrift countries, and the recent spike in yields is beginning to echo past instances when so-called bond vigilantes wielded their power in protest of profligacy. Say that 10 times fast. In protest of profligacy. The theory goes that if investors impose higher borrowing costs, governments eventually bow to the pressure and retrench. I don't know. How borrowing costs have been going higher for a couple of years now. I don't see a lot of governments bowing to pressure or retrenching anywhere, but hey, maybe that'll happen. But Besson is kind of shrugging off this Moody's downgrade. Besson warns some steep Liberation Day tariffs may return and dismisses the Moody's downgrade. U.S. Secretary Scott Besson warned Sunday that some of America's trading partners could soon face another sharp hike in tariff rates and dismissed Moody's downgrade of the U.S. government credit rating agency. In an interview Sunday morning with NBC News' Meet the Press, Besson said President Trump's so-called Liberation Day tariffs, most of which were suspended for 90 days, may be reimposed if countries do not negotiate in good faith before the pause expires in early July. They're going to get a letter saying, here's the rate. So I would expect everyone would come and negotiate in good faith, Besson told NBC anchor Kristen Welker on Sunday. On Friday, Trump said his administration will unilaterally impose new tariff rates on some countries in the coming weeks, telling people what they will be paying to do business in the United States. The negotiating leverage that President Trump is talking about here is if you don't want to negotiate, then it will spring back to the April 2nd level. Besson added, noting that many countries face tariff rates far higher than the current 10%. So, I guess these letters are going out. We talked about this Friday. They're going to send a letter saying, here's what your tariffs are going to be. And it looks like they're going back to those April 2nd levels, which, April 2nd came out. The bond market threw a fit and they said, okay, 90-day break. And it looks like nobody's doing anything over those 90 days, or at least a few countries are. Besson is talking about the 18 big trading partners that he's focused on. He's saying everybody else is going to get a letter and probably go back to April 2nd if they don't offer something. So we got that going for us, which is nice. Meanwhile, the UK and the EU trade and defense reset in a new era for relations. US and EU the UK and the EU striking a deal, walking back Brexit this morning. Britain agreed the most significant reset of defense and trade ties with the European Union since Brexit on Monday, after U.S. President Trump's upending of the global order pushed the two sides to move on from their acrimonious divorce. Nearly 9 years after it voted to leave the bloc, Britain, the second largest defense spender in Europe, will take part in joint procurement projects. The sides also agreed to make it easier for UK food and visitors to reach the EU and signed a contentious new fishing deal. Isn't this all the stuff Brexit supposedly got rid of? Well, it's back. It's back. Starmer, who backed remaining in the EU during the Brexit referendum, also bet that offering benefits to Britain, such as the use of faster e-gates at EU airports, will drown out cries of betrayal from Brexit campaigner Nigel Farage. So the EU and the UK getting back into bed together. There's Ursula and Mr. Starmer. I'm not sure who that third guy is there, but they're having a party this morning. Also, another deal that does not surprise me one little bit. 23andMe sells gene testing business to DNA drug maker Regeneron. And yes, folks, that's right. You were the product all along. Bankrupt genetics testing firm 23andMe agreed to sell its data bank, which once contained DNA samples from about 15 million people, to the drug developer Regeneron Pharmaceuticals for $256 million. The sale comes after a wave of customers and government officials demanded that 23andMe protect the genetic data it had built up over the years by collecting saliva samples from customers. Regeneron pledged to comply with 23andMe's privacy policy, which allows customers to have their personal information deleted upon request. So you should still be able to get your stuff deleted, whether they do it or not. I guess it's up to you or up to them. But this one, not really surprising. They're selling our data. Turns out Spit worth about $253 million. Go figure. And just a little bit of a warning, guys. Get ready for some jawboning this morning. This screenshot shows, looks like Fed's Bostic was speaking at 8:30 a.m. Jefferson and Williams are speaking right now. And we've got two more Fed speeches scheduled for later this afternoon, Logan and Kashkari. There's all kinds of jawboning going to go on this morning. So if you see any big sudden moves in the market, probably because one of these Fed muckety-mucks said some Fed muckety-muck thing and the market reacted to it. Also going on this morning, some student loan borrowers see credit scores plummet by over 100 points. I don't have 2 or 3 years to wait for my score to come back, says somebody who probably should have been paying their bills this whole time. Credit scores are dropping. Most federal student loan borrowers have been required to make monthly payments since those payments resumed in October of 2023, following the nearly 4-year pandemic pause. But borrowers who couldn't or didn't over that period were still shielded from some of the potential consequences, like having their delinquency reported to credit bureaus or defaulted loans sent to collections. That grace period has come to an end, and loan servicers began reporting delinquent accounts to credit bureaus in January of 2025, and wage garnishments for borrowers who are more than 270 days late on payments are expected to resume soon. Borrowers throughout the country have reported massive credit score drops as loan servicers resumed reporting delinquent accounts to the credit bureaus. Nearly 14% of borrowers had at least one loan 90 days past due in the first quarter of 2025, according to the New York Federal Reserve report. So look, big drops in credit scores. If you haven't made a payment on your student loans in 5 years and your credit score is suddenly declining by 100 points, you probably should not be surprised. All right, not to downplay the financial difficulty that you and freaking everybody else has had to live with over the last few years because of inflation. But the fact is, this is a loan, not a gift, which means you pay it back. You were told to start paying it back 2 years ago after a very generous 3 years of not paying it back. And if you still haven't been paying it back, well, boo-hoo, your credit score goes down. You're going to have a hard time borrowing anything. But also worrying here, guys, is the asset-backed securities market. Keep in mind, credit scores are inputs into the risk associated with mortgage bonds, with auto loans that go into asset-backed securities, with, yes, securitized student loans and securitized buy now, pay later loans. So what happens when the credit scores of all the people who borrowed that money drops by 150 points? What do you think happens to the value of that asset-backed security? And if you're sitting there saying, I don't care, guess what your 401k or your pension or your IRA is probably invested in? Those same bonds. This is going to cause problems in the ABS market. You better believe it. I've got Locks and Melody coming on the channel later this afternoon to talk about just such an occasion. And the last thing we got to talk about this morning is this one. All right, I'm just going to read this first. I'm going to hold my nose and I'm going to read it. This is President Trump on Truth Social. He said Walmart should stop trying to blame tariffs as the reason for raising prices throughout the chain. Walmart made, all caps, billions of dollars last year, far more than expected. Between Walmart and China, they should, as I said, eat the tariffs and not charge valued customers anything. I'll be watching, and so will your customers. My Trump needs a little work. Don't worry, it's a work in progress. But look, this is stupid, guys. What is he saying? He said Walmart shouldn't raise the prices. All right, you put 145% tariffs on Chinese goods. All right, now they're down to 30 or whatever they are. All right, prices go up when you do that. This is, and he's zeroing in on Walmart saying, excuse me, saying they made billions of dollars last year. What is this, greedflation all over again? Is that what we're at? This was stupid when Joe Biden said it. This was stupid when Kamala Harris said it. All right. Inflation is not caused by greedy companies. Inflation is caused by stupid monetary policy that enables reckless fiscal policy in Washington, D.C., reckless fiscal policy, which you are now widely engaged in, Mr. President. So don't sit there and blame Target or blame Walmart for higher prices. Own it. It was your policy that did this. Stand in front of it. This is threatening price controls here. When he says, I'll be watching, and so will your customers. Are we talking about price controls again? This is stupid. All right. And I don't know why this happens all the time. Republicans, they campaign like conservatives and fiscal conservatives. Then they get into power and they act like Democrats and they wonder why they lose re-election every time. Look, I called out Biden for this. I called out Harris for this, and I'm calling out Trump for this. This is freaking stupid. This is not what I voted for. And with that, I just want to say thank you very much to Mr. Who's that? Hey, real estate. What's up, Travis? My buddy Travis was first today with his lucky 777 there. Thank you so much, brother. By the way, Travis, thank you for everything you have been doing on the property tax front. I got a lot of comments about that video I did late last week about that couple in Florida that saw a 500% increase in their property taxes because they renovated their home. And Travis and Mitch over at Real Estate Mindset have been taking that issue head on. They're actually suing in Texas court because of what's been going on with property taxes, where the schools are basically saying to the county assessors, are saying, well, we need this much money, go find it by raising property taxes. And then the county assessors are basically saying, in order to raise this much money, we need to revalue homes by this much. And that's what they're doing. In other words, schools are de facto dictating the value of homes to the assessors in order to extract more wealth from homeowners, many of whom are on fixed incomes, in order to pay for their budgets, instead of doing what everybody else has had to do, which is make sacrifices to meet the rising cost of living. Travis and Mitch are taking that issue head on over at Real Estate Mindset. So, Travis, thank you so much for what you're doing, brother, and for the support of the channel. New Engineering, what's going on, brothers? He says, currency race to the bottom has started. Run, go. Well, we've got the Dixie is certainly racing lower this morning, albeit from a higher level. Remember, the Dixie strengthened dramatically for a couple of weeks there in April. We shot up from like 98 to, what did we go as high as 101, 102 at one point? Now we're back right around that 100 threshold here. But yeah, it looks like the dollar race to the bottom here, or at least the Sell America trade is on this morning. Sharply weaker dollar. I tell you, man, that ECB story there, keep an eye on that one. I'm used to hearing that kind of talk from YouTubers. I'm used to hearing that from gold bugs. I just can't help but overlook that. We're talking about central bankers are now talking about defaults on physical gold, squeezes higher, threats to financial stability. It's not something you usually hear a central banker talking about. So I agree. The race to the bottom in currencies is underway. Thank you, New Engineering, for supporting the channel. And Armando Reyes, thank you, sir, for supporting the channel. He says, John Whitehead said the martial law will be declared by 2030 due to economic collapse. Didn't they already declare martial law in 2020? Isn't that what they did? They pretty much put the whole freaking country under house arrest. They arrested people for going to the gym. They arrested people for going to church. I don't think that is so crazy to believe. I really don't. I mean, we were pretty much there a few years ago. I think that the world, I was shocked at what the world was willing to accept from our totalitarian overlords in the first half of this decade. And I shudder to think what they'll accept in the second half of this decade. I don't think that sounds so crazy. It doesn't. A few years ago, that might have sounded crazy. Today, it's Tuesday. It just sounds like a Tuesday. Thank you, Armando, for supporting the channel, sir. And Home for Your Money, thank you for becoming a new member of the Melonheads, and welcome, sir. Thank you so much. Appreciate the support of the channel. By the way, shout out to all my magnanimous Melonheads on YouTube and Patreon as well, guys. Links down below should you feel so inclined. Thank you, Home for Your Money. And we've got wait, hold on. I missed one. Pigo, what's going on, Pigo? He says, I need some yelling with my Moody Monday. Oh, let's see. What does Janet have to say about the Moody's downgrade? Well, let's Secretary Yellen, former Secretary Yellen, tell me your thoughts on the Moody's downgrade. Well, I think it's actually kind of hilarious that Moody's waited until I was out of the job to downgrade the credit rating, because really what Moody's is saying is that Secretary Bessent, my predecessor, who has to clean up everything that I screwed up epically, now they're saying because he's doing exactly what I did, that finally they're going to downgrade, even though Fitch and Standard & Poor's are way ahead of them on that one. So good luck, Scott Bessent, and if you need me, I'll be at the University of something collecting my speaking fees in exchange for services rendered. Well, thank you very much, Secretary Yellen, once again, for your unusual candor that you demonstrate every time you come on the channel. I don't know why we get such honesty from Secretary Yellen when she comes here. It's like she puts on a whole new face. She really lets her guard down. I guess we just make her feel comfortable here. Am I disarming like that? I don't know. Thank you, Pigo, for supporting the channel, brother, and for queuing up Janet, as always. M&J gifted 20 Nobody Special Finance memberships. Wowza, M&J. Thank you so much for supporting the channel, both with the 20 new memberships and that blue wrench next to your name. Thank you for keeping things neat and tidy in the chat, as always. And to you 20 new lucky Melonheads, be sure and say thank you to M&J for doing that. And just a reminder, guys, you get once a month a free super chat with that Melonhead membership. So feel free to use that one, and I will read and respond to your question on the air, as Mr. Pastaman is currently doing. He's saying misleading statements. Say it isn't so. What were the misleading statements? Was that in reference to Michael Saylor and his infinite money glitch? I don't know that Saylor actually made, well, let's be honest. Anybody who's listened to Michael Saylor talk for more than a few minutes in an interview, all right, he makes misleading statements all the time. Now, did the company put out misleading statements? That's open to interpretation. All right, I think the company, what MicroStrategy is doing is very reckless. I mean, they are wild, man. That guy is like, that guy's a little too comfortable with risk. What was that girl, Caroline Ellison? Was that her name? The girl from FTX who made that famous interview when she's saying you got to get comfy with risk. Yeah, maybe not that comfy. Maybe not that comfy, Caroline. Saylor's a freaking wild man. Now, is what he's doing with the infinite money glitch illegal? I don't know. Probably not. It's going to blow up in his face one day if he's not careful. And right now, I would say strategy is probably still the leading candidate for the cause of the next crypto winter, which will happen at some point in the next 5 months. There will be a catastrophic crash in Bitcoin. Just based on the prior 3 halvings, it is incredibly likely that we see something like that. So as always, guys, be careful on leverage. Thank you very much, Pasta Man, for supporting the channel. And Steve Woitis says, RE23andMe sale, drug companies will contact us. You are genetically susceptible to blank. Here's your personalized drug cocktail that we will sell you. Well, before they do that, they got to get the insurance companies to agree to pay for it. And then once they do that, then the insurance companies say, well, magically, we need to raise your premiums in order to pay for the cocktail that was made pretty much with your spit. So, yeah, all right. Who had Regeneron spit cocktails on their 2020s bingo card? Man, you just got to love this decade. It ain't always fun, guys, but it's never dull, is it? Yeah, I wouldn't be too surprised. By the way, things are shifting. I don't know if things are changing right now, but there has been a very strong shift in the attitude towards healthcare in this country. I hate to say it, but since the assassination of that UNH executive. And that's not to say that anything good came out of that assassination. It didn't. It was a murder in the streets, and it was a condemnation of us as a civilization entirely. But that being said, United Health has done nothing but cascade lower since then, and it's pulled back the curtain on a lot of the BS that these companies have been doing. And so maybe we'll see some change in the way we address healthcare here. I don't know, though. That's a lot of entrenched power. And United Health, so far, they've gotten away with it. They're only under investigation. Nobody's been charged or convicted of anything yet. And based on how we treated Boeing with the kid gloves, once again, Boeing being let off the hook with a deferred prosecution agreement in order to satisfy or settle from their violation of the last deferred prosecution agreement, doesn't give me a lot of hope that they're going to fix things with the insurance companies. But thank you, Steve Woitis, for supporting the channel, sir. And Mr. BTB, I shan't read that name on the air. He says, love to hear from Janet today. Well, we already heard from Janet today, so we're not gonna take out old Secretary Strong and Resilient a second time just today. But thank you, Mr. BTB. Appreciate all the support of the channel and the enthusiasm for Janet. Nashville Pasta Man is back again. He says $300 million buildings lose 85% of their value. City taxes go away. City officials look to residential taxes. Oh, so maybe we got this commercial real estate bubble bursting over here. Oh, no, what happened to our tax receipts? Better crank up the tax rates on mom and dad in their townhouse in order to cover the difference. Commercial buildings collapse and your assessments go up. That money's going to come from somewhere. I mean, silly rabbit, you don't think the government's going to cut spending, do you, when their incomes drop? Of course not. Governments cut spending. That's only something poor people do when they go broke. Governments just print or tax more money into their own coffers. They don't ever cut spending. Governments don't ever make do. They don't ever have to make hard choices. That's what you have to do in order to pay for it. Isn't that nice? Thank you so much, Nashville, for supporting the channel. Thank you guys, all you guys, for the generosity this morning in the super chats. and for having your coffee with the Melonheads once again. Shout out to my magnanimous Melonheads on Patreon and YouTube. Thank you guys for supporting the channel. Links down below should you feel so inclined. Don't forget that like button and that subscribe button on the way out for the algorithm. Hi, Mom. Hi, Dad. I love you guys. And everybody, till next time, live small and dream big.